Joining us now is Simon Gallagher from SPG Global. He's also a former executive at Hulu and Netflix. Simon, is really this strike and the movement that we see right now in media about oversupply? I mean, there are nearly 3 times as many shows out there as there were 14 years ago. And when supply goes up, doesn't the price you're willing to pay go down?
The price you're willing to pay, I think we're seeing, again, I've always said this when I come on CNBC, the value for money that people are getting out of these services is extraordinary. A lot of people will have gone to have seen the Mission Impossible movie and spent $80, $90 for a family of 4, whereas Netflix, tremendous value at $15. All the services, tremendous value at around that price point, particularly when you consider the amount of content that they've produced for those services, the amount of originals, up from about 370 titles in 2019 to around 1,300 titles.
But if you're a studio or if you're the distributor, I mean, the price you are willing to pay to the actors, to the writers, right? Yeah, I mean, if you're producing all this content, chasing subscribers, chasing advertising, and there's all this content out there, isn't there an impact?
Well, there's a lot of content out there, and this is what I think the SAG negotiators are missing the point on. They need to go back to the fact that there is more work for their union base out there that's coming in from Netflix, from Amazon, from Apple. They need to recognize that, and I think it's more important about focusing on the way that they're being paid. It's not a pay TV driven model anymore where titles are going into syndication. This is a streaming led financing model, and you do get paid up front. That's the nature of the model, but they need to keep in mind the streamers and the networks and the broadcasters and the studios are paying more per episode for a piece of content, and there's more content being produced. So I really think there's an enormous disconnect in the way these negotiations are being handled.
But for investors, I wonder, should there be so much content being produced? I mean, you've got Bob Iger saying that they overproduced. You've got Apple, which is doing pretty well now, always having a relatively more conservative model for how much content they were putting out there. Is, in effect, what we're seeing that there's too much stuff out there, and maybe for the content creators as well at some level, for these media companies themselves, they have to produce less and maybe rethink the balance of volume to quality?
I don't think you can look at it and apply the same blanket to everyone, John. I think you need to look on a case-by-case, a streamer-by-streamer basis. And we look at Netflix, and that's why the share price is up like it has been over the past months and since year to date. It's performing very well. They're producing the most content. They seem to be producing the content that's resonating with consumers. I think some of the other streamers absolutely need to go and have a look. Are they producing too much content? And more importantly, are they producing the right content?
So I wonder what happens to some of these stocks, Netflix included, and we'll prioritize Netflix since they're reporting in just a couple of days. If we do get a slowdown driven by the labor force in the U.S. of the amount of content that they are able to produce, does that bust any business models? Does it advantage anyone particularly? If this isn't just a moment in time, if really the result is, hey, there's a slowdown in how much stuff is actually being produced.
It really does highlight again the importance of sports, because if you look at this, sports is protected from this scenario. So yes, there is going to be less content that is produced. Yes, there is going to be less content available to put on these streaming services. But I look at Netflix and I have been very impressed with the sports-themed content that they've been producing. They don't have live sports rights, but what they do have is Drive to Survive, the golf show, the tennis show. They continue to produce content in this space. So in some way that protects them a little bit from this slowdown. Certainly Apple Plus, they're very well positioned with Messi recently signing for the new team, and he'll start playing. So that will drive the Apple Plus subscribers. So some of the services are protected better than others.
Do you have an expectation for how long these 2 strikes are going to last?
I don't have an expectation because I don't have any visibility into the negotiations, but I go back to the fact when I look at the numbers and I look at the data, my expectation is that I don't think the negotiations are being managed all that well on the SAG side. I think they're arguing for the wrong things. I think there needs to be a degree of flexibility in what they're asking for. They're pushing for things like they're concerned about generative AI. The world leaders in AI don't know what AI is going to look like 24 months from now. I don't expect that they should either, but what they should be asking for is the right to lock something in for the next 2 years and then revisit it. It doesn't necessarily need to be we'll revisit this in 10 years. So I think, like any negotiation, everyone just needs to dial back the levels of angst and try and come to a happy medium. And I'd like to think that SAG will see that.